Most people think life insurance is just something you buy when you die. But here's what they don't tell you. The wealthy use life insurance as their secret wealth weapon, and they couldn't care less about the death benefit. They're playing a completely different game than everyone else. There are actually 3 levels to how life insurance works. Level 1 is basic protection. That's what most people know. Level 2 is permanent legacy building, guaranteeing money passes down. But level 3, that's advanced wealth management that eliminates estate taxes and creates tax-free money that you can access while you're alive. In this video, you'll learn how each level works, why the ultra-rich focus on the living benefits instead of the death benefit, and how level 3 changes everything about building and protecting wealth. Most financial advisors only know level 1, so stick around because this gets really interesting. Let's start with level 1. This is what most people think life insurance is all about. You've got a young family, maybe you're 30 years old with a couple kids, and you're thinking, if something happens to me, how does my family survive financially? So you go out and get $1 million in term life insurance coverage. You're probably paying $100 a month for 30 years of coverage. This is pure protection. If you die during those 30 years, your family gets $1 million to replace your income and keep their lifestyle going. This makes total sense when you're young because you don't have much money saved up yet. Your biggest asset is your ability to earn income, so you're basically insuring that income stream. If you can't work anymore because you're not here, the insurance replaces what you would have earned. Most people stop right there because they think this is all life insurance does. You pay the premiums, and if you die, your family gets money. That's it. And honestly, for a young family just starting out, this level works perfectly fine. But here's where it gets limiting. As you start building real wealth, let's say you're now 45 and you've been successful. You've got some investments, maybe some real estate. Your income has grown significantly. You start thinking differently about money and protection. The mindset shift happens when you realize you're not just trying to replace income anymore, you're trying to build and protect assets. You're thinking about legacy, about taxes, and how to pass down wealth efficiently. That's when level 1 starts becoming pretty basic. At this stage, most people are choosing between term and permanent coverage. Term is cheaper up front, but expires, usually right when you're older and more likely to actually need it. Permanent coverage costs more, but it builds cash value and never expires as long as you pay the premiums. Here's the thing though, at level 1, you're still thinking about this backwards. They're focused on the death benefit and treating the policy like pure insurance. They might choose permanent coverage, but they're not really understanding how to use it as a financial tool. The common mistake I see all the time is people thinking level 1 is the only way to use life insurance. They get stuck in this mindset that they're just about dying and leaving money behind. They never learn about the living benefits or how to access cash value while they're alive. But once you understand that life insurance can be a wealth building tool instead of just protection, everything changes. You might start looking at policy design differently. You start thinking about the cash value you can accumulate, how quickly it grows, and how you can access that money tax-free through loans. That's when you're ready to move beyond level 1. You're not just protecting your family's lifestyle anymore. You're building a financial foundation that works for you while you're alive and creates a legacy when you're gone. The wealthy figured this out a long time ago, which is why they use life insurance so differently than everyone else. Now, let's talk about level 2. This is where people start thinking beyond just replacing income. You're dealing with someone who's built up some assets, maybe they're in their 50s or 60s, and they want to guarantee something specific passes down to their kids or grandkids. Here's a typical example. Someone who wants to leave behind $200,000 to their family. They're looking at permanent life insurance and they're willing to pay a couple $100 a month to make sure that that money is guaranteed to be there. The key difference in level 1 is they're not just protecting against lost income anymore, they're creating a legacy on purpose. With permanent coverage, the money you put in goes directly toward building the death benefit and some cash value. But at this level, the death benefit is still the main focus. You're thinking, I want to guarantee my kids get this money no matter what happens to my other investments. This is where permanent coverage really starts to make sense. With term insurance, you might pay the premium for 30 years and then the coverage expires right when you're most likely to need it. But with permanent coverage, as long as you keep making the payments, that death benefit is locked in. Your family will get that money whether you die the next year or in 40 years. The person at level 2 thinks completely different than someone at level 1. They're not just hoping their investments will last long enough to leave something behind. They want certainty. They've probably seen what happens when the market crashes, wipe out people's retirement plans, or when long-term care costs eat up someone's savings. Let's say you've got $500,000 invested in the market for your retirement. You're probably hoping that that money lasts through your lifetime and maybe leave something behind for your kids. But what if there's another 2008 style crash right when you need to start withdrawing money? What if you need expensive medical care that drains your accounts? With level 2 life insurance, you're saying regardless of what happens to my money, I know that for certain my family will get this death benefit. It's like putting a floor under your legacy planning. The cash value might grow over time, but it's secondary to the guarantee. This appeals to people who live through enough market volatility to understand that nothing is guaranteed except death and taxes. They've seen friends lose half their retirement savings in a crash and never recover. They've watched families fight over what's left of an estate after medical bills and taxes. The cash value does grow in these policies, but at level 2, you're not really focused on accessing it while you're still alive. You might borrow against it in an emergency, but you're mainly letting it build to support the death benefit. You're thinking of this as money that's set aside specifically for your beneficiaries. What's interesting is that many people get stuck at level 2 because they don't realize there's a completely different way to use life insurance. They think the death benefit has to be the main focus. They don't understand that the wealthy have figured out how to flip this whole thing around and use the cash value as their primary wealth building tool. That's where level 3 comes in, and it changes everything about how you think about life insurance, taxes, and building wealth. This is where everything flips upside down and you start thinking like the wealthy. At level 3, you're dealing with business owners or high net worth individuals who figured out that the death benefit is actually secondary. They're using life insurance as a sophisticated wealth management tool, and the cash value growth becomes the primary focus. This is how it works. Instead of buying life insurance to protect against dying, you're buying it to build tax-advantaged wealth while you're alive. The policy is designed with proper cash value emphasis, staying under the MEC limits so that you maintain all the tax benefits. You're putting in significant premiums, maybe $10,000, $20,000, even $30,000 a year, but most of that money is going towards the cash value, not just paying for insurance costs. The wealthy use this as what I call a volatility buffer. Instead of selling investments during market downturns, they access the cash value through their policy. Let's say the market crashes and your stock portfolio is down 30%. Most people would be forced to sell at the worst possible time to access money. But if you've got a properly designed whole life policy, you can borrow against the cash value at maybe 5% interest while your investments recover. This is huge because you're not locking in losses during market volatility. Your investments can recover while you use your life insurance cash value to fund your lifestyle or business needs. Then, when the market bounces back, you can pay the loans and your cash value keeps growing. You've essentially used life insurance as a personal bank that doesn't care about market conditions. But here's where it gets really interesting. For high net worth individuals, estate tax elimination. If you've built a significant wealth, you're looking at estate tax rates that can hit 40% or higher on amounts over the exemption limits. That means if you want to pass down $10 million to your kids, the government might take $4 million of it in taxes. Here's the numbers that matter. The federal tax exemption is around $12 million per person, but that's scheduled to drop significantly in a few years. Many states have their own estate taxes, which much lower exemption limits. So if you're successful in business or real estate, you could easily be looking at massive tax bills when you try and transfer wealth to the next generation. This is where life insurance becomes a wealth transfer machine. You can use the cash value during your lifetime, and when you die, the death benefit passes to your beneficiaries completely tax-free. So instead of leaving behind $10 million that gets hit with a $4 million estate tax bill, you structure things so that the life insurance death benefit covers those taxes and your other assets pass down intact. The leverage play here is something most people never understand. You might put $2 million into a properly designed policy over 10 or 15 years. The policy might have a death benefit of $5 or $10 million. So you've essentially leveraged your premium payments into a much larger tax-free benefit to your heirs. But remember, at this level, you're not thinking about death benefit. You're accessing the cash value through loans during your lifetime. Maybe you borrow against it to fund a business opportunity, real estate investments, or just to maintain your lifestyle without selling other assets during market downturns. The death benefit is there as the ultimate wealth transfer tool, but the living benefits are what you're really focused on. This requires completely different thinking about money and legacy. At level 1, you're thinking about replacing income if you die. At level 2, you're thinking about guaranteeing a specific legacy amount. But at level 3, you're thinking about optimizing your entire wealth strategy for taxes, liquidity, and control. The policy design here is critical. You want maximum cash value accumulation within the legal limits. That means working with someone who understands MEC limits and can structure the policy so that you're putting in as much money as possible while maintaining the tax advantages. Most insurance agents don't understand this level of sophistication. They're still thinking about selling death benefit coverage. Here's what the wealthy figured out that most people miss. They're not trying to minimize their life insurance premiums. They're trying to maximize them within the legal limits. They want to put as much money as possible into these policies because of their unique tax treatment. The cash value grows tax deferred, but you can access it tax-free through loans. And the death benefit passes tax-free to beneficiaries. Think about it this way. Where else can you put money that grows without current taxation, gives you tax-free access through loans, and passes to your heirs without estate or income taxes? That combination of benefits doesn't exist anywhere else in the tax code. That's why the wealthy use life insurance as a cornerstone of their wealth management strategies. The mistake most people make is thinking that it's too complicated or that it's only for the ultra high net worth individuals. But if you understand the concept and work with the right professionals, you can start implementing level 3 strategies even when you're not worth tens of millions of dollars yet. The key is understanding that you're not buying insurance, you're building a tax-advantaged wealth accumulation and transfer system that happens to include a death benefit. Here's what most people never realize. They get stuck at level 1 because they don't even know levels 2 and 3 exist. They think life insurance is just about dying and leaving money behind, so they buy the cheapest term policy they can find and call it good. Meanwhile, the wealthy are mastering all 3 levels for different purposes at different times in their lives. When you're young and building wealth, they might use level 1. When they're young and building wealth, they might use level 1 for basic protection. As they accumulate assets, they move to level 2 for guaranteed legacy planning. But once they understand advanced strategies, they're operating at level 3, where the death benefit becomes almost secondary to the living benefits. The key insight that changes everything is this. At higher levels, it's not about the death benefit anymore. It's about the living benefits. It's about the tax-free growth, tax-free access through loans, volatility buffering, and estate tax elimination. The death benefit is just the cherry on top to a sophisticated wealth management strategy. Here's the problem though. Your current financial advisor probably only knows level 1. They're thinking about life insurance as pure protection, not as a wealth building tool. They might even tell you that you should buy term and invest the difference because they don't understand how properly designed permanent coverage works at levels 2 and 3. If you want to move on beyond basic protection, you need to look for policy designs that emphasize cash value accumulation within MEC limits. You want to work with someone who understands how to maximize your premium payments for wealth building, not minimize them for cheap coverage. The wealthy didn't get rich by accident. They use every legal tool available to build and protect their wealth. Life insurance at level 3 is just one of these tools, and now you understand why they use it so differently than everyone else.